Hello and welcome to Capital Impact Strategies. Today we are talking about taking withdrawals in a bear market. I'm Craig Ivey and I've got Ashley Trelitza here with me. Good morning, Ashley.
Morning, Craig.
So thought this was a pretty relevant topic given the market that we've experienced so far this year. I know we've recovered quite a bit, but it's a question that I think a lot of people have is it safe to pull money out when my portfolio's down? So here we go.
Yeah, and it is a great question and one that we seem to get pretty often. In fact, a couple of times recently come to mind where clients have called in almost apologetic. I know the market's down. I need to take some money out. And timing does matter. We'll talk some more on this as we go along. But one thing that we always try to keep in mind is that volatility is inevitable. We're always going to have periods where the market is maybe not where we'd like it to be, or a little more volatile than we enjoy. But for clients, especially in retirement age, the distribution needs are there. They're not, you still need to be able to fund that lifestyle or
Right.
spending for things. So it is challenging. It can challenge sort of strategic planning, how we've mapped things out. Certainly a lot of emotional components go into that as well, of this sort of you know uh, hesitance to pull money while things are down. You've got to think
Right.
about it, especially with our bigger clients, tax planning things and their legacy goals. But it is, like I said, inevitable that you will find yourself in a position where there need to be withdrawals taken while the market's off.
Yeah, and you made a point about it's inevitable, which is true, and I think I would even add that the average market during a calendar year experiences, I think, from its peak to its bottom, the average is like 13%. So
Right.
even, today we're talking more specifically about bear markets, but you're going to have volatility within any given year. So good point.
Right. Right. Uh,
So you can kind of see this chart where it talks about historical bear markets going, I think, all the way back to the late 1800s. Probably good to define some of the terms that we're going to be using today. So bear market, you're talking about the market being down 20% or more. A correction is going to be 10% or more. And then probably intertwined with the commentary that you might get from the media is going to be recession. So
mhm.
when we talk about bear markets, corrections, we're talking about market performance, whereas recessions are, an actual, economic condition where we've had, two successive quarters where we've had negative growth. So, but today we're talking, kind of isolating just bear markets, which is specifically, market conditions. So, probably nobody on the webinar today, remembers, 1929 crash or
Right.
post-war. But, a lot of our listeners will, think about Black Monday, kind of the inflation of the 70s, different things, maybe Cuban Missile Crisis, but, and then everybody will kind of remember 2008 and, more recently the pandemic. So it just shows you that, we're going to have these markets but the encouraging thing is we're going to recover from them as well.
Yeah, I think that's maybe the most interesting thing to see in this graph is if you're living through some of these times, especially when it's, a longer period where markets are off, it sort of feels hopeless and we're never going to dig ourselves out. But I mean, you look at the chart and even coming out of like an 08, 09, COVID was a shorter period, but there is
Right.
still growth happening if you stay invested for the long term and sort of all those things
Right.
that we talk about.
Right. Yeah.
Um, another piece of this that wanted to maybe define some terms around and get everyone familiar with also is this idea of cash flow planning. So again, some listeners maybe have experienced this or done this exercise before, but we certainly focus on it with our clients on the outset is to establish what the base case looks like. So this would be a, long range, 25, 30 plus year projection that we're trying to put together based on, fairly conservative assumptions, but the idea being to identify what's lifestyle spending look like, you know,
Right.
given the client's asset base, what's sustainable. We're accounting for inflation, we're accounting for income taxes. And the real core idea here is we're taking the time to understand real spending. We're taking the time to understand what does it actually take to, run my lifestyle. And this is the distribution scheme that's going to be necessary, travel and cars and kind of all those things included. But if you've got a really solid base case projection, then you can get into things like looking at, well, how does this hold up against a bear market? Again, we're
Right.
working in a model. It's not, perfect prediction, but as close as we can get with computer simulations to establish, well, how does our plan look? Are we workable? Is this feasible? It'll give you a lot of insight when we get into some of the next things we'll talk about, including market volatility in those numbers.
Yeah. I mean, one of the things I know we've got it on the slide is inputting basically real spending numbers. I know that this has come up in conversation recently, but do you think that it's just as important to have realistic investment return numbers as
Oh,
we're kind of doing
100%.
this? Okay.
Right. So, looking back over history, the S&P returns, frequently in excess of 10%. And, I think it can be easy to be tempted to build models in where you've got these really rosy projections, you're really, pedal to the metal. But for most clients in retirement age, you're not 100% in the market, right? So we
Right.
really
Yeah.
do try to build in some realistic return expectations around, well, if we are 40% in fixed income, if we are kind of ratcheting back the risk profile of this portfolio, what's a more reasonable return assumption? And then always keeping with our theme of conservatism, I'd rather model under expected
Right.
market returns and then have the market over deliver, right, than set
Right.
expectations, unrealistically.
Yeah, I think back to probably the 70s and 80s, maybe even before then. But you'd have actuaries that would try to help with these, defined benefit programs, and I think you'd
Yes.
especially see it kind of at the municipal and the state level, where they'd make promises about, what they could do as far as a pension amount. But a lot of times, baked into the numbers were overly rosy investment assumptions. And then that's why you see, some large cities or states that, struggle to meet those obligations because, they have baked
Yes.
into the return assumptions, maybe north of, 11, 12% or beyond that. So, yeah, I agree that that's important. Okay. So, you know, brief history, try to be very brief on, kind of the history of cash flow planning. In the earliest days, we just had this is what this type of portfolio would traditionally return. We do that every year. We subtract expenses and taxes, and so kind of on a linear basis, if we're, planning to live to 85 or 90, do we still have money left at the end? Then maybe you go to more historical returns where you say, okay, well, if we started taking withdrawals in May of 1981 instead of today, and we ran it through, would it hold up against historical markets that we can look back on? And then to today, where it's more mathematical, where we're saying this is the average return, and we want you to vary it 1,000 times. So I think it helps in that it puts additional stress on the portfolio. So we're
Right.
saying, okay, what if there's even some really bad conditions, right in a row at the beginning of the time that they start taking distributions? And so, I think at the bottom you can see test against worst case scenarios. I think this allows us to do that.
Yeah, it does. Actually, I've got a kind of visual of what this might
Mm.
look like in the simulation software. So to your point, it's a statistical model. So we're not we're not just copying a historical pattern of returns, we're creating a range of possible outcomes based on an average, standard deviation, variance, up or down. And what the software will do is produce this scatter chart where you've got your kind of dark blue line in the middle that's showing, well, this is if the market's sort of on average, what we would expect or hope for. And then you can see you've got kind of a lighter blue shaded area above, so that would represent above market returns. And then the yellow shaded area is really what we're talking about today, is that below market segment. So the idea being, can we model a range of possible outcomes for a client that takes into consideration you're not going to hit the average every year. It's going to fluctuate up and down depending on how much risk is in that portfolio. We can simulate that in our computer model, but are we able to withstand below market returns and still end up with, some investable capital at the end of our life expectancy assumption, which is really what this is trying to key in on, is what is that range, and can our withdrawals continue even under lower than ideal market conditions?
Right. And I'll pick on you a little bit. So, I know that we actually get kind of a score, or the percentage of the number of times that we had successful attempts. A lot of times for our firstborn, high achieving, A type people,
Not me.
yeah, tell us about, we're not
Sure.
necessarily shooting for 100, right?
Sure. So in addition to this chart, the system will produce a success rate, basically. So it's run 1,000 iterations of this exercise, and what percentage of those led to a positive outcome in the simulation, meaning we got to life expectancy and we did not exhaust our financial capital. So 100% obviously would be the top, but that's not necessarily what we're aiming for in this exercise. It's somewhere more in that 85 to 90% range, meaning when you're running a simulation like this, you're really operating in a vacuum. So it's not sophisticated enough to say, well, if the market's down, we might not take that trip. Or,
Right.
if my portfolio is off 25%, maybe I don't pay cash for a car, right? The expense assumptions are operating on their own independently, and then you're varying these market returns. So what ends up happening is you could be over conservative in your lifestyle and enjoyment of things if you're really shooting for 100% all green in a Monte
Right.
Carlo type simulation. And that is something that we revisit year over year with clients. Is more of a check-in. Are we kind of on track? Is our number about where it was, versus a one-time exercise? Here's my marching
Right.
orders, and I'm not going to change for right. It's much more flexible of an exercise than that.
Right. So I think this goes to your point about clients during a bear market being almost apologetic in, needing to take money for, and it could be property taxes, or they're paying, income taxes, or it's just their regular distribution. But timing agnostic, meaning we're not basing, either our lifestyle or the things that we do that we've planned for, based upon how the portfolio looks. Because going back to the Monte Carlo, going back to the cash flow, we've planned for these things. We've planned
That's
for
right.
taking distributions in a down market. We want to continue to do the things that, we need and want to do. You've spent a lifetime acquiring this money, and it's intended for you to use. So, and then I even think, this idea of regular monthly distributions can kind of flatten out, the over time, the impact that you're having on the portfolio. So kind of the reverse of dollar cost averaging, where people are used to putting $100 a month. Sometimes they're getting lower prices. Sometimes they're getting higher prices.
That's right. Yeah.
So yeah, not being kind of a slave to the balance sheet every moment is important.
Yeah, that's absolutely right. And The next slide speaks to asset allocation, which is, you know, the other big piece of this is, are we well diversified, and how does that help smooth the ride out? So if you imagine we've planned for this, we've run the cash flow, we've come up with our monthly distribution need, and then we are also able to sort of test out in our software different asset allocations, try to identify, well, what's appropriate for this specific individual? How much risk do we need to take, or can we back off?
Right.
Having a good broadly diversified portfolio helps smooth out that ride as well. And we'll get into more detail in subsequent slides, but just having different places to go to source distributions, right? So stocks versus bonds, what's held up, what's off, maybe a cash reserve, even that may be the next slide. But point being, if you're well diversified and we've got the risk level appropriate to this individual situation, that's also a big component to sort of what we're talking about and helping people stay on track, maintaining distributions through down markets, and sort of smoothing out and creating the least stress as we can.
Yeah, and we may get to this in another slide, but it's a good point that, you know, can we raise cash, place trades, fund distributions with something that has held up well? So I know we don't have a slide, but if I think, so if I think about like Fidelity Total Bond, or there's a Barclays Ag, you know, which is, you know, a bond index. If you look at that for kind of year to date 2025, it's a much smoother ride than, you know, the S&P 500
just
index
being
or the
all
NASDAQ.
stocks.
Yeah. So, so you've got this where it's got kind of annualized returns over the last, you know, 20 years or so, for kind of a you know, what we consider maybe a most likely kind of portfolio,
a moderate
for somebody,
portfolio, retirement age,
taking distributions. And so, you know, you can see one, I would say that the market is up most of the time. I think if we measured it going back to, you know, its earliest days, it's up 2/3 of the time, down 1/3. So I think there's some confidence that can be, you know, gained by looking at the reality. And then, you know, if you're looking back to 08, that's where you can see kind of that -22. But if you were just looking at the calendar year return for stocks, you know, you'd be looking at the high 30s or low 40s. So it definitely
much broader
flattens
spread.
out.
Yeah.
So but that's a great chart.
Yeah, I like this one too. I think it's really interesting to see, you know, just even on this time span, how often the market is up in a 60/40 portfolio versus down. I'd love to bring this chart out. I mean, I think it's just a striking visual and helps people really cue in, because if you're just listening to headlines, you know, a lot of that is centered around what's the NASDAQ doing or what's the S&P 500 doing. So it may be easy for people to clue in on that and think, oh gosh, you know, the market's off 25 or 30%. What am I going to do? But in reality, if you're allocated more like this, maybe you're down 10 or 15%, right? Just depending on how the portfolio is structured, but really nice visual. So this is a little bit what we were talking about, is this buffer for withdrawals, where you have different buckets to go to. You know, you're not forced into selling out of your stock portfolio to fund distributions. Just as a general rule of thumb, we liked our retiree clients to hold about 3 to 6 months worth of their living expenses in cash. That's, of course, a different rule of thumb if you're working and accumulating, but if we're in distribution phase, that's a good kind of guidepost of, let's just park in a high yield checking account or savings account. It's ready and available. If the AC goes out or something, we've got it covered. You can write that check. Then within the investment portfolio, obviously having a reasonable amount invested in fixed income provides another buffer, where generally speaking, when the market's down or we're experiencing, you know, bear market conditions, those positions tend to hold up a little bit better. So as we're sourcing cash month to month for clients to send out, that gives us somewhere to go and raise that cash from. That's held up a little better. little more resilient. It just creates some nice flexibility to be strategic and, again, smoothing out the ride and making sure that we've got places to go to for cash is important.
Yeah, absolutely. And we're coming up on the season where air conditioners fail. So I think that was a good example. They
It's
don't
always in
fail
my
in
mind as a
February.
Houstonian.
No failures of ACs in February. So yeah. So when we talk about sourcing of withdrawals, most people that we work with are going to have um, counts with different types of tax consequences. And then, as we look deeper within the actual investments inside of those accounts. So prioritizing tax efficient distributions, do we need to make sure that we don't add to your tax return by distributing too much from your 401k
Right.
or your IRA? So there you've got kind of taxable, which means you've already paid taxes on these dollars. So you may be paying for the growth, but not for the overall distributions. Then you've got your IRAs, which are very simple in that it's as if you just earned it in that calendar year. And then of course your Roth is growing tax free. So unlike the cash flow that we showed earlier, where it's a very long-term exercise, do we have enough? Is our spending appropriate? Is our investment policy appropriate? All of those things. The tax is more of a year by year. Let's plug everything in. Should we take more out of an IRA because we don't have a lot of things that are filling into our tax return? We haven't
Those
started
low
Social Security yet.
brackets, right?
Yeah. So it's not just about saving taxes. It may be, being efficient. Of course, we're not a CPA firm. We can, kind of provide some feedback, maybe, even suggest some strategies, but ultimately the CPA is going to be the one that blesses it and signs off on it.
Yeah, absolutely. Okay, so I think this may be the last prepared slide we have, and it is my favorite. Just, you work hard, you build your wealth, we get to retirement, and it's there to enjoy. It's not there to be a source of fear or anxiety. So, always keeping in mind that bear markets are temporary. We can look back in history and see the charts and the data. Your values are not. So, you again worked hard. It's time to enjoy, travel, spend time with family. Uh, Planning for this helps a lot, and really, if we can help our clients stay the course and stay on track, that's sort of what we're here for. The second bullet point on here, I think, is really key. Is a lot of times, if the market's down or it's down for a longer period of time, we'll get the phone call, "Hey, am I okay? Right? Should we keep going?" And one thing that I love about what we do is it is a living and breathing exercise, right? This stuff is all very I'm searching for the word, but
Yeah,
we're
dynamic or
dynamic, right? So
yeah.
oftentimes, if it means just schedule a quick meeting, come into the office, meet on Teams, let's revisit the cash flow, let's rerun it. So plugging in new asset values to represent a shift in the market, rerun that Monte Carlo and see where we are, and that in of itself creates a lot of comfort and encouragement for people to see, okay, now even with it off, we're going to rerun this and it still works, so I can still go and do, or I don't need to change my plan. That's key to all this as well.
Yeah. And I think Ashley has helped me a lot on this front because I tended and maybe still do to be kind of, fist slammed on the table, make sure you're spending your money. Because in looking back with families that I've worked with, one of the dangers is that you underspend and underuse your capital because, well, is this the best time to take the
Right.
trip, give the
Right.
money? And, we're really limited, not just in the amount of time that we're going to be here on this earth, but also the amount of energy. So if you look too myopically at what my portfolio says today and you defer something that you really wanted to do, 5 years from now, you might not be as mobile or have the
That's right.
energy or, so I think it's really important to have a plan, have confidence in the plan, and do the things that you plan to do. So, like I said, Ashley's helped me to not be as, pound the table. You got to do this, but
Well,
it is something that's
I
important.
it is important, and I think if we're able to confirm it with good planning, modeling, and create some sort of numerical confidence around it, then yeah, of course, especially in those early years
Mhm.
post-retirement when you've got the
Yeah.
energy and the time and your health is good to go and enjoy and do the things you've dreamt of doing your whole working career. So
Right.
I think that is the last slide. We've got about 4 minutes left in our
Okay.
presentation time. I don't know if we want to check the chat for questions.
Yeah, let's do that. And obviously, if you're watching this today and participating, um, it's impossible to kind of cover the whole question or the whole topic. So please reach out if you have any questions. We're here to help. But yeah, let's take on a few questions from the chat. Okay, let's start. We've got, and I'll do the easy part and read the questions. We'll make Ashley answer them. So top of the list is, do you often use Roth IRAs for distribution, so to fund your lifestyle?
Yeah, that's a great question. So, and it is obviously very specific to that individual situation, but generally speaking, we would try and follow that tiered list that we put in one of the slides where you're kind of going between the taxable account and maybe the IRA as your first line of distributions, especially if you've got someone who's retired, earlier, say in their, early 60s or so, you may have 8 or 10 years before your required distributions begin from that IRA. So, being able to go ahead and start pulling money, filling up those lower brackets can be really beneficial. Roths are a great inheritance for your heirs. It works really
Yeah.
nicely into the estate plan. So, where we can avoid pulling from the Roth generally seems to work well for families.
Okay. I 100% agree and have nothing to add. Let's see. I love just putting this all off on you. Okay, so okay, yeah, this is a good question. You said when you're running the cash flow, you want the asset allocation and the risk to be appropriate. Somebody asked, is there the potential that somebody could be overly conservative, not take on enough risk to meet their goals? It's a good question.
Yes. Yeah, it's a great question. And yes, we actually see that on both sides. So certainly, if you're, overly concentrated in cash, we see that a lot. People that, oh, I've got, a boatload of cash in the bank. It's just sitting there. This is what I'm living off of. And then, over time, inflation really erodes that asset out. So
Right.
putting that to work can be, paramount importance. On the flip side, we also have seen a few where maybe they come in and they're 80% or higher in equities, and we can really ratchet that back and say, no, you don't need to take on this much risk. Let's smooth things out a bit. So, great question. Works on both sides of that, and certainly something that our planning process addresses. I
Do
think
we
we've
have
got
time
time for
for?
maybe one more. Yeah.
Okay. All right. Um, oh, okay. Yeah. So I don't know if we covered this. I think I kind of gave the terms and definitions for bear market. Um, so the question is, so it's down 20%, or the stock market is, and we talked about that. But what if it's down more? So what if it's, you know, financial crisis or something we've
Mm.
experienced where it's more like, 40 or 50% down on the equity or the stock side?
Yeah, yeah. So that's obviously more impactful. First line would be to go back to that cash flow model and let's check the numbers. That may be a case where we want to shift spending a bit, or really think about how we're sourcing withdrawals. Could also be a great time to rebalance. If the market's off and there is cash to put to work, that an opportunity to buy in when it's on sale. But certainly something we'd want to work closely together on and monitor a little more often than kind of your typical market conditions.
Yeah, I Completely agree. And I actually made the point earlier about the simulation or the computer program kind of being ignoring whatever the market conditions might be at the time. So it doesn't account for, let's say that we got a COVID bear market or a, '08 experience. We definitely seek to be buyers rather than sellers in that market.
In
So that
that
can provide,
simulation.
yeah, and then another boost to, your capital and your ability to spend. Um, so I guess that was the last question. We're coming up on 30 minutes, or maybe past it.
Yeah, we're 30 seconds over, but no, I think that's want to be mindful of everyone's time who's joined us
Sure.
today.
Yeah. Okay. So thank you for joining us today. Again, capital impact strategies. We're talking about distributions in a bear or a down market. You should have our contact information, and probably us covering 3 questions out of the ones that were on the chat is not a lot. So feel free to reach out. We'll be happy to try to answer those. So we're here to help.